And good evening. This is the Elliott wave update for the S&P 500 for Tuesday, March 29th, 2022. The S&P continued higher today to no great surprise. And I've made a slight adjustment on the count. So let me start with where we are, and then I can review what took place on the change. We remain within the structure for an intermediate wave 2 corrective bounce. And that started off of below on the 24th of February at 4101, and thus far has soared. It is doing extremely well. It's up to 40, I got up to 46.31 today. So we remain within inside that intermediate wave 2. This is intermediate wave 1. We're completed, and we did 5 waves down a minor degree. And so all of that remains the same. Let me set just a little bit so it looks a little bit more to scale, I guess. And so the rally that truly began on March the 15th has been astounding. And partially because it's being done against a backdrop that is absolutely dismal. And that's the one that's over in the bond market. The bond market and the 2-year, the 5-year note, the 10-year note, they have been collapsing while this market is cruising with the excuse of, well, this is a relief rally because, you know, Ukraine and Russia, they're going to sit down, they're going to work out neutrality agreement. Okay, boom, we're going to go buy stuff. But, you know, the reality is that right now, on a quantitative basis, they remain looking for the premium, and doing those types of trades effectively is calling in for long, being long the underlying. So in any case, here we are. Now, I have switched and just brought things down a little bit and put the B wave in here, the A, the B. So this completed the A wave. This little pullback, which actually was last week, is the B wave. And now we're heading higher in wave C, which will consist of 5 waves of minor degree. Now, what we've done within that is waves 1 and 2, and I'm, while needing to leave open the potential for a finishing little move back up towards 46.38, maybe a little higher, but I'm looking for the completion of the minute 3. We get a 4th wave, which is going to essentially, okay, so we're not getting it that way. Again, I guess it might be my desk. There we go. This is the zone. This is the previous 4th. So we get into, see, and you can see even within this, it looks like it might still need a slight new little one that gets up to that 46.38 number. Can do it overnight. And then we drop, get back into here. We've got support in our moving averages. We've got fairly could be strong support at 45.86. And that's all based on that the buyers are still sitting on the sidelines and waiting, and or they already have been moving in, et cetera, et cetera. So the buyers should remain strong. But we need to get a 4th wave correction in. So if we get 1, 2, and this is 3 up in here, we get that 4 in, then we're going to turn and we're going to start to move higher again in a wave 5. That advance right now, I continue to look for within the following zone to complete that move. Now, remember, the most common Fibonacci relationship between a C wave is to its A wave. And the A wave here was fairly strong and fairly quite large. So the most common for the C wave would be that it is 0.618% times the length of that A wave. And that comes in at 46.83. Right above it, we have a nice little zone that has been built, still holding us below 48.08, which is the all-time high. I think we get close. So 46.83 or 46.84, then 47.17, then 47.48, 49, up into that 47.50 area. Then we have the all-time high at 48.08. I cannot right now say with definitive whatever conviction that the market will not go above that level. That would be a mistake for me to say that, because the possibility is here. We're seeing these incredible rallies of 50 plus points, where the NASDAQ is putting 239 points out. The Dow is up over 300. When we're seeing this type of volatility being pushed into the market against a backdrop, and I'm just going to briefly take you over there to look at this thing. Here is the 10-year note. Now I'm going to flip it out to at least the daily chart, if not the weekly chart. And you can see, I'm going to go to that weekly chart. That really shows the picture cleanly over this extended period. This has been pretty seriously down, right? From June of 2021, August of 2021, excuse me. And it's just been pretty much straight down. And since the beginning of March, on a weekly basis, we've been down 3 weeks, and this fourth week is still in progress. So that's the 10-year note. They're collapsing. The canary in the coal mine, if people want to call it, is going to be the 10, the 5, and the 2-year notes. The canary is dead. That's what I'm going to say. The canary is dead. This is the 5-year. Look at this. Bam. They're selling. While we in the stock market and the equity markets are rallying harder. Because that's what here's the 2-year. The 2-year is really 1, 2, 3. This is the 4th. That was almost a doji, these little dojis. But then before that, we had 1, 2, 3, 4, 5, 6, 7, 8 months. 8 months down, coming into February, of downside action in the 2-year note. They've been expecting this, but it's turning out to be more than what they thought. 2-year notes started way up here and now are way down here. So what the stock market is not getting is exactly that. Oops, wrong one. So bear in mind, I really do think that when we're done with what we're doing, and again, I don't really, does not to me make a difference if it is here, up a little bit higher, or new all-time highs. The move that comes after is destructive, is going to be fast, it's going to be more crash-like than what people, I think, are anticipating. Things are not okay. Things are not okay with the US government. Things are not okay with the Federal Reserve. Things are not okay. The Federal Reserve is behind the 8 ball. I mean, they're painted into a corner that they're desperately trying to test to see if the paint's dry and they can get out, but they can't because they got to paint a new story. And the fact is that we are so behind, according to what you can see in the 2-year note, the 5-year note, and the 10-year note. The story is telling us a whole different thing. It's telling us to prepare for recession. It's telling us that gold is really in a bind here because they can't figure out whether it should go up or down. So now we can add gold to that story, to what's really happening. There are other mitigating factors, but the primary one is realizing that the time to pay the pauper is now. The piper, the pauper, whatever, it's now. That's what's happening. The market to continue to go up is the biggest setup by a very corrupt system if it actually happens. So please be careful. Please just trade accordingly. If you've got positions on, don't be married to them. This is not going to end well. You may continue to believe otherwise, but it's not going to end well. So protect yourself. In any case, for tomorrow, continue to look for upside. We're looking for a little bit of a correction. And then that final move, which could take us to complete intermediate wave 2, let me say, that it could take us as high as 47.50. We have initial resistance at 46.38. I'm going to allow it to complete wave 3 of C and then get a 4th wave pullback. And then that 5th wave, first resistance would be 46.84, then 47.17, and then 47.48 to 50. All right, I'm going to leave it right there. The next update will be on Wednesday, March 30th.